Session 7, Financial Management. So using the reports that you receive during the game, you'll be able to calculate contribution margin. Contribution margin is a product's price minus all associated variable costs. This results in discovering the incremental profit earned for each unit sold. You have to be very careful with this. So say for example, if you're selling tablets for $1,500 and the standard unit cost is $1,150, you have a unit contribution margin of $350. However, that does not mean that you're making a profit of $350 per product, because also you have to consider the indirect costs of the business. These indirect costs come in the form of storage costs, reinvestment in machines, and all the investments you're making to increase your product's appeal, such as promotion and advertising, R&D, financial expense, and also you have financial expenses, income tax, and also the cost of purchasing additional information. So for these reasons, you can't just make all pricing decisions based on contribution margin. Now, the key to financial management, as in this game, as in all businesses, is to keep a very close eye on your cash flow. If you have expectations that you're going to be cash flow negative in the period ahead, you should be planning to take out loans. If you fail to plan, then you could get unstuck in a sense. You'll have to pay more money because you'll automatically be receiving overdraft loans. The rates of interest that you pay on these different types of loans are obviously different. For a planned loan, you pay 0.7% a month initially, although that can increase over the course of the game if your debt levels go up too much. And revolving or overdraft credit, on the other hand, will cost you 1.4% per month. If you think you're going to have excess cash to play with, you can apply that in the money markets and you can return 3.35% per month. Interest on loans and investments is debited and or credited that same month, whereas revolving credit interest is debited only in the following month. A couple of points of note. Try not to invest and loan at the same time, because obviously your income from interest is less than your interest expense, so that doesn't make any sense. The second aspect to financial management is monitoring your share prices. Share price is one of the potential strategic goals you can weight more heavily in your game, and that's a decision that you'll be making at the outset. If you do weight it more heavily, you need to consider strongly the things that go towards improving your share price. The three key factors are your shareholders' equity, your profit, both size and the trend, and finally your dividend distribution.